In this video, I'm going to be showing you how to catch 30 pips per day using the London breakout strategy. This is a very popular trading strategy, but in this video, I'm going to be showing you a very different way of trading the London breakout strategy, separate from what you see and what you watch on other YouTube videos talking about London breakout strategy and all that. If you're a subscriber to this channel, you probably know already that I don't trade. I'm not a fan of trading breakouts. So in this video, I'm going to be showing you a special way of catching the breakouts trading the London session. Some of you might have heard of market makers. Some of you might have heard of smart money. The strategy I'm about to show you is going to be based off of the concept that market makers and smart money manipulate the market and go to liquidity areas to take out the liquidity before they move in their intended direction. And we don't want to be part of the people that are being taken out when the market makers go to take out the liquidity. So it's going to be a scalping strategy. You're going to have to be looking for a 1-to-1 or a 1-to-2 risk to reward on these trades. Now, if that sounds interesting, let's get into the video. Make sure you subscribe to the channel, hit the like button, and let's get into the charts. Before we begin, there are certain indicators that you need when trading these strategies, and these are the indicators here. So first of all, you're going to need the 13 moving average, the EMA exponential moving averages. So you're going to need the 13, the 50, and the 200. You're also going to need session boxes. All right, this is going to plot out your Asian session, London session, and the New York session, so you can know what time of the day you're placing the trades, right? Because if you're not going to place the trades during the Asian session, you have to place the trades during the London session or the New York session. And then the last but not the least, you're going to need the day separator. Now, this day separator is this vertical line you can see here. It separates one day from another. So this is Thursday and this is Friday, right? So it separates each day, the start and end of each day, right? So if you want to add your the indicators to your screen, just simply go to indicators here and then search for exponential moving averages. Right, so you can add your exponential moving average there and then put these numbers on those moving averages, the 13, the 50, and the 200 EMA. And then for the session boxes, you can use any session box you want, but I personally use the one by FXN, right? So the name is FXN Asian Session Range, right? So this plots out my Asian session box, the non-session, and the New York session. And if you want to add these vertical lines, the day separator, simply right click on your mouse, go to settings on trading view, go to events, right, events, and then click on session breaks. You can see if I turn it off, it goes off. If I turn it back on, it goes on, right? So you're going to need these three indicators. Once you've added them to your charts, then let's get into the good stuff. All right, so here's what you're going to be looking for. You're going to have your boxes plotted out, but I'm going to plot out only the Asian session box. You have seen, if you've been a subscriber to my channel, you've seen me draw this a lot of times, right? So you're going to have the Asian session consolidation, right? The market's going to consolidate during the Asian session, right? Coming into the London session, you're going to expect two things. So there are certain things you're going to need, right, when trading this breakout system. So when the market breaks out, for example, to the upside, you're not going to just blindly buy these breakouts. You're not going to buy these breakouts, right? So what's going to happen is you're going to wait for something to happen. So you're going to wait for the market to come back to retest this Asian session box and then reverse from there. Why does that happen? The reason why that happens is because the Asian session box acts as support and resistance. So basically, this is the resistance, this is the support if you extend this outward, all right? And then the middle is also a range. This is also you can call this support or resistance, anyone, right? So these are areas where the market is gonna react to. Now, before they make this breakout, before market makers break to the upside or break to the downside, there's always liquidity above and below these boxes. Now, this liquidity has to be taken out, and when the market makers take out this liquidity, a new area of liquidity is created, because what happens is when the market breaks out of this Asian session consolidation, some people are going to be buying this, right? So you know the London breakout strategy, a lot of people are going to be buying these breakouts straight up London session. So what's going to happen is it's going to create liquidity below this area, below the resistance that just got broken. Remember, they tell you that you should put your stop loss below the entry bar, put your stop loss below the resistance zone, right? So a lot of people are going to put their stop loss in here. So what's going to happen is market makers are going to come back, take out the liquidity at that area, and then make their move to the upside. So what's going to happen in the mind of the retail trader that just got stopped out is that, you know that feeling when you buy, you predict that the market is going to go up for the day, you buy into that breakout, right? Then the market comes back down, takes you out, and then you're like, oh man, it took me out. Then you stand aside, and then what happens? You close your laptop, or you close your screen, and then you come back some hours later, and then you see that the market has gone in your favor about 50, 100 pips in your favor, right? And then you realize that your prediction was right, but you got stopped out before the move happened, right? So you couldn't profit from that move. Why? It's because market makers know where your liquidity, know where your stop loss is located, right? And if they want to go to this upside, they want to remove as much people as they can that are trading to the upside, right? I don't know if you understand what I'm saying. So if a lot of people are going to be buying and market makers want to go up, they have to go back down and take out the people that are buying so that they can continue back up, right? So this is kind of like a break and retest type of thing. So you're going to wait for the market to come back to these areas, to bounce off of these areas. Also, when the market breaks to the downside, you're going to look for the same thing. Now, they can also come all the way to the middle of the Asian range. That one too also works, right? So they can also come to the middle of the Asian range and bounce off of that, right? So basically, you have to first wait for the breakouts and then wait for the retest of this area of this box, and then you can look for an entry to take that up. One other thing you're going to need also for confirmation, for additional confirmation, is the bounce off of this Asian range also has to bounce off of the 50 EMA, right? So you're gonna have a 50 EMA right here, like this, and this is gonna bounce off of that 50 EMA. And then when the market makers break to the downside also and come back to retest this area, you're gonna have the 50 EMA here like this. So they're gonna bounce off of the 50 EMA. All right, so I'm gonna show you a couple of examples on the screen on the chart to make this clearer to you. So let's get on those examples right now. Let me share my screen. All right, so if you can see my screen, this is an example on GBP card, right? So we're going to be looking for 30 pips, right? So let's see if we can get 30 pips on these moves. Now, it depends on the currency pair you're trading. This is a volatile currency pair, right? It moves about 100 pips per day. So 30 pips it's not going to be very far. It's not going to be very difficult. But if you're trading currency pairs like maybe Euro GBP or CAD CHF or things like that are not very volatile, 30 pips is gonna be a lot, right? So 50 pips on GBP card might be too much on cards on pairs that are less volatile, right? That's gonna be a huge move. Some pairs, the max they move per day is like about 50 pips. Right? So if you're looking for 50 pips on those pairs, you're not gonna see it. So let's look at a couple of examples here. Let me grab my pen. All right, so what do we have here? We have our Asian range. This is our line. You can extend this line out. That's the resistance. This is the support, right? And then this is the middle of the range, right? Let me redraw that. This is the middle of the range around here. So what happens? The market makers break to the downside coming into London session. A lot of people begin to sell these breakouts, right? And when they sell this breakout, where do you think their stop loss is going to be? Above the entry bar, above the support area that just got broken, and also above here, right? So what happens? The market comes back down, comes back up, takes out the liquidity in that area, and then makes it move back down. Now, where are you going to enter on this? You can see that this bounces off of the 50 EMA, right? So one thing you're going to have to also take in mind is identifying the trend. So if the 200 EMA, which is this black moving average here, this is the 200 EMA, right? So if this 200 EMA is above price and above this box, that means you're in a downtrend. And if the 200 moving average is below price and below this box, like if the 200 EMA was down here like this, going like this, right, then that means you are in an uptrend. Just to put that in mind, because if you don't know the direction you're looking for, you're going to get confused, right? So you have to, because this is a continuation type of setup, this is a scalping continuation trade. So you don't want to be in consolidation, and you don't want to be trading this going against the trend, right? It's not going to work that way. You have to go in line with the trend. So the market makers come back inside, right? and then you're going to enter on the close of the 13 moving average, which is this red moving average here. The red moving average is the 13 EMA. All right, so you're going to enter here when the candle closes below this red EMA, the 13 EMA. You can put your stop loss here, or you can put your stop loss here, and you can aim for 30 pips. This went for about 50 plus pips, about maybe 55 or 60 pips if you add this week. All right, so this went for 50 pips. Out of this 50 pips, you can catch maybe like 30 pips around here. Or if you want to go for the full 50 pips, you can go for that. But 30 pips is a good range, depending on the pair you're trading. All right. So let's look at another example. We have another example here. As you can see, the EMA crossed over here. So that means we're in a downtrend. The 200 EMA is above price. All right. So what happens? The market breaks to the downside. All right. A lot of people begin to sell in here. Price comes back, takes out their stop losses. Right. Their stop loss is going to be here and here. And what happens? The market goes back down. Now you can enter here, put your stop loss here because this closed below the 13 EMA, and then you can, if you waited and entered here, you can see this is an M formation here. All right, so if you entered here, stop loss can go here. This went for about 60 pip move, 63 pip move. All right, so out of this might be a 1-to-1 if you put your stop loss up here, or a 1-to-1.2 or so, risk to reward. Let's look at another example. Here we have the 200 EMA above price, right? The 200 EMA above price. We have the 50 EMA below the 200 EMA. So that tells us that this is a downtrend. This is the downtrend. So we're going to be looking for sales. So we have our Asian session here. Market breaks to the downside, then comes back up to take out the liquidity that is located above here and above here, right? Market comes back down, you can enter here, put your stop loss above there, or you can enter maybe somewhere here. All right, this went for about 70 pips. So out of these 70 pips, you can catch maybe 30 pips, 40 pips, 50 pips, or maybe the whole 70 pips if that's your take profits. Now, let's move to the next example. Here we have another example here. This is the Asian session consolidation here, right? Extend this out. Extend this out. Now this one came close to the range here, but didn't really touch it. It came very close to the range. But also what we can see here is that it bounced off of this 50 EMA. So that's also plausible. You can enter here, put your stop loss below here or maybe here. This went for about 50 pips. Here we have another example. We have our Asian session consolidation here. Market makers take out the liquidity above. They come back down. A lot of people bought this. Their stop loss got hit. A lot of people sold this here on the close of this candle. Stop loss got hit. Bounces off of the 200 EMA. Sorry, off of the 50 EMA. All right, you can see it bounces off of the 50 EMA here. You can enter here, put your stop loss above here or above here. This went for about 40 pips on this move. And we can also see that this is a downtrend. You can see that the 200 EMA is above price and also above the 50 EMA. So that tells us that that is a downtrend. Now we have the final example here. We have our Asian session consolidation here like this. Extend your box. What happens? Market makers break to the downside. People sell here. People sell here. The stop losses here. Here. Market makers come and take out their stop losses. Closes below the 13 EMA. You can enter there. Put your stop loss above. This went for about, how many pips was this? This went for about 60 pips. All right. So 30 pips would be about half of this. So from here to here, this took about 1, 2, 3, 4. In 4 candles, that is in 4 50-minute candles in 1 hour, you have hit your 30 pip targets, and then you can close for the day. All right, so this is a form of scalping, and I hope you enjoyed this video. If you like this video, click the like button, subscribe to the channel for more videos like this, and I'll see you guys on the next one. Peace.